Hey everyone, welcome back to my channel. Today we're diving deep into a topic that's been creating quite a buzz in the real estate world, the housing bubble burst. A lot of you have been asking me about the factors that contribute to this phenomenon and what signs to look out for. So in this video, we're going to break down the key ingredients that often lead to a housing market crash. Understanding these factors can help you make more informed decisions, whether you're buying, selling, or simply want to stay ahead of the curve. Let's get started. Picture this: everyone and their uncle is buying up property, not necessarily because they need to live in it, but because they believe they can flip it for a quick profit. This is the very definition of speculation, and it's often one of the first signs of a bubble. When demand outpaces supply, driven purely by this speculative frenzy, prices start to skyrocket. Properties become overvalued, meaning their prices are significantly higher than what their actual worth should be based on their rental, income, potential, or long-term appreciation prospects. This creates a dangerous scenario where the market becomes unsustainable, like a house of cards ready to topple. Investors, fueled by FOMO, fear of missing out, often overlook fundamental indicators like rental yields or price-to-income ratios. They're essentially betting on the fact that prices will continue to rise indefinitely, which, as history has shown time and time again, is simply not realistic. Now let's talk about debt, the fuel that often ignites the fire in a housing bubble. When lending standards are relaxed, meaning it's easier to qualify for a mortgage, more people jump into the market, further fueling demand and driving those prices even higher. Think about it. Lower interest rates, low down payment requirements, and flexible loan options make homeownership seem more attainable, leading to a surge in borrowers. But here's the catch. This increased borrowing leads to higher levels of leverage, meaning people are taking on more debt relative to their income and assets. This can create a precarious situation where even a slight dip in the market or a change in interest rates can push borrowers towards the edge of default. Suddenly, that dream home can quickly turn into a financial nightmare. Remember those low interest rates that made borrowing so attractive? Well, what goes down must eventually come up. When interest rates start to rise, it directly impacts mortgage rates, making those monthly payments more expensive. This increased cost of borrowing can deter potential home buyers from entering the market, cooling down demand. For those who already own homes, especially those with adjustable rate mortgages, rising interest rates can significantly increase their monthly payments, potentially leading to financial strain. As affordability becomes an issue for both potential and existing homeowners, demand weakens, putting downward pressure on prices. This shift in the market can be a wake-up call after a period of exuberance, forcing both buyers and sellers to reevaluate their positions. Economic downturns or recessions can act as the pin that pops the housing bubble. When the overall economy weakens, it can lead to job losses, reduced income, and a decline in consumer confidence. This economic uncertainty can make people hesitant to make large purchases, like buying a home. Furthermore, those who lose their jobs or face financial hardship may struggle to keep up with their mortgage payments, leading to an increase in defaults and foreclosures. As more homes enter the market as a result of these distressed sales, it creates an oversupply, putting further downward pressure on prices. In a nutshell, economic downturns can expose the vulnerabilities of an overheated housing market, leading to a domino effect that ripples through the entire economy. As we've discussed, several factors can contribute to a decrease in demand in the housing market. When prices become unaffordable due to factors like overvaluation, rising interest rates, or economic downturns, potential buyers often delay their home buying plans, opting to rent or wait for more favorable market conditions. This decrease in demand is further worsened by an oversupply of homes on the market, often resulting from speculative buying and an increase in foreclosures. As the market shifts from a seller's market to a buyer's market, sellers may be forced to lower their asking prices to attract buyers, leading to price corrections or even a full-blown price decline. This shift in market dynamics can be a challenging adjustment after a period of rapid price appreciation, requiring both buyers and sellers to adapt to the new reality. Defaults and foreclosures are often a lagging indicator of a housing bubble burst, meaning they become more prevalent after the bubble has already started to deflate. As mentioned earlier, when homeowners face financial difficulties due to job loss, rising interest rates, or other economic factors, they may fall behind on their mortgage payments. If they're unable to catch up, lenders may initiate foreclosure proceedings, ultimately leading to the forced sale of the property. These distressed sales typically occur at lower prices than market value, as lenders are often eager to recoup their losses. As more foreclosed properties enter the market, it creates downward pressure on prices, further exacerbating the decline in home values. This cycle of defaults and foreclosures can be particularly damaging to neighborhoods and communities, leading to blight, decreased property values, and a sense of instability. The final nail in the coffin of a housing bubble burst is often the loss of consumer confidence. As prices decline, potential buyers may become hesitant to enter the market, fearing that prices may fall even further. This wait-and-see approach can further dampen demand, creating a self-fulfilling prophecy of price declines. News headlines and media reports often amplify this sentiment, highlighting the negative aspects of the downturn and further eroding consumer confidence. This negativity can create a vicious cycle, where fear and uncertainty drive market behavior more than rational analysis. Rebuilding consumer confidence after a housing bubble burst takes time and requires a combination of factors, including economic stability, government intervention, and a shift in market sentiment. So there you have it, a breakdown of the key factors that can contribute to a housing bubble burst. Understanding these factors is crucial for making informed real estate decisions, regardless of market conditions. If you found this video helpful, please give it a thumbs up and share it with your friends who might benefit from this information. And don't forget to subscribe to my channel for more insightful real estate content. Thanks for watching, and I'll see you in the next one.